In this video, you will learn tips for Forex trading beginners. Starting out in the FX trading market can be a challenging endeavor, even for experienced traders. That's why having a well-thought-out trading plan is a crucial component of any trader's toolkit, especially in the highly liquid Forex market. Here are some key points to consider before creating your trading toolkit. Start small. A common mistake made by many novice traders is diving straight into trading without a well-thought-out plan. Instead, start small, consider using $1 per point or the minimum trade size, and gradually build your confidence. In trading, there's no such thing as beginner's luck. You may experience both winning and losing trades. Starting with small amounts allows you to make mistakes early on without incurring significant losses. For instance, if you begin with $10 per point and the market moves against you by 25 points, you will lose $250 right away, impacting your confidence. It's crucial to understand that markets rarely move in your favor immediately upon entering a trade, so taking a cautious approach can be beneficial in the long run. Select your market/instrument. Conduct thorough research on different markets and assess your comfort level with their volatility. Determine whether you prefer short-term gains or gradual profits accumulated over time. If you're seeking short-term gains, focus on active markets with a relatively high daily range compared to the price spread. Markets with tight bid/offer spreads provide more liquidity, which is beneficial if the trade goes against you, as such markets offer better opportunities to close positions quickly. Set clear objectives. One essential rule is to trade with the trend. Go long when the market is rising, and go short when it's falling. Attempting to pick the top or bottom of the market is usually not a prudent approach. Instead, decide where you want to enter the market when it's rising or falling and place your trades accordingly. Develop a risk management strategy with predefined stop-loss and take-profit levels. Avoid trading impulsively. Being neutral and patient is also a strategic position. Keep it simple. Avoid overcomplicating your analysis with numerous technical indicators, as they can sometimes provide conflicting signals, leading to confusion. Focus on fundamental key questions. Is there a clear trend? If there's a sideways trend, consider staying on the sidelines. If it's an upward trend, look for buying opportunities, and if it's a downward trend, consider selling. Identify support and resistance areas and make informed decisions based on these key levels before placing trades. Implement effective money management. Money management plays a crucial role in a trader's overall profitability. The temptation to take quick profits can often lead to losses. Traders may meticulously manage stop losses but fail to apply the same discipline when capturing profits. To ensure profitability, adopt a 50-50 approach, aiming to make a profit on at least 50% of executed trades. Before entering a trade, determine the amount of money you are willing to risk, such as $100. Aim to achieve a profit of at least $300, so even with a 50% success rate, you maintain an overall profit. Discipline is essential both during successful and challenging periods. Avoid the common mistake of setting unrealistic stop-loss and take-profit levels on unsuitable markets. For instance, a 100-point stop-loss may be realistic for Euro to US dollar but not suitable for shares. Use price ranges over recent days and months as benchmarks when defining stop-loss levels. Adopting appropriate money management strategies will enhance your trading performance and safeguard your capital. Analyze the past. A fundamental aspect of the technical approach is evaluating historical price data, as the Dow theory suggests that history repeats itself. By examining past price action on an asset, traders can gain insights into its future behavior based on previous patterns. Human behavior tends to follow predictable patterns under certain circumstances, and the technical approach capitalizes on this. Market forces are driven by people, just like traders, who experience emotions like hope, greed, and fear. Identifying previous highs and lows and understanding the market's behavior at those levels can provide valuable clues for formulating various strategies using what-if scenarios. Know your own statistics. Analyze your trading history by keeping a record of all your transactions to identify patterns in your profits and losses. Understanding where you succeed and fail enables you to eliminate unprofitable trades and focus on those that lead to positive outcomes. If you're losing money, take a break. When experiencing consistent losses and a lack of success, it's crucial to take a step back and reassess. Consider setting a monthly float as your trading capital, and if it depletes, take a break from trading for the rest of the month. Use this time to clear your mind and start fresh in the following month. Resist the temptation to recover lost money by impulsively chasing the market. Use oscillators and moving averages wisely. Avoid solely relying on oscillators and moving averages to determine trends. Instead, use them to complement your analysis of trends, support, and resistance levels. Oscillators may indicate overbought or oversold conditions, but it's essential to consider the broader market context before making trading decisions. Combining different technical tools can enhance your understanding of market dynamics and improve your trading performance. Focus on one trade at a time. Avoid overwhelming yourself with multiple trades. Often, simplicity is the key to successful trading. Concentrate on one trade at a time and prioritize high-quality opportunities over quantity. Consider trading costs. Be mindful of carry costs when holding positions overnight or over multiple days. Selling a high-yield currency may incur higher costs compared to a lower-yielding one, impacting your overall profitability. If you enjoy this video, be sure to like and subscribe for all videos Forex and investing related.